Okay, think about this for a second. What if you get the raw power of a high-end supercar, but it only uses the energy of, like, an electric scooter? Sounds pretty out there, right?
Almost like science fiction.
Exactly. But there's a company in the AI chip space claiming, well, basically that, and the market. It reacted explosively. Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks.
Yeah, today we're doing a deep dive into GSI Technology, that's ticker GSIT. We're really digging into this dramatic 155% jump we saw, all based on our research data captured on October 21st, 2025.
All right, let's set the stage. The overall market right now, it's kind of soft, a bit mixed. The Dow and S&P are just about green, maybe.
Yeah.
But the NASDAQ, the tech side, it's definitely weaker. Doesn't exactly scream risk on.
Right, and if you zoom out, the bigger economic picture for 2025, well, forecasts have been pointing towards a cool down. But there's this, maybe call it an AI buffer. Investment keeps flowing into genuinely disruptive tech, which means a single really solid catalyst, like we saw with GSIT, can have an incredible impact.
And GSI definitely dropped one, a fundamental bombshell, really. There was this independent study came out of Cornell University, and it validated the performance of GSI's own hardware, their APU, the Associative Processing Unit.
Exactly, and the tech itself is fascinating. The APU uses associative processing, so it's more about memory-based processing, not like the usual compute focus you see in standard GPUs. And the difference is just staggering. The Cornell study confirmed it delivers the same AI performance as a top-tier NVIDIA GPU. But, and this is the kicker, it uses over 98% less energy.
Wow, okay, 98%. That's not just an improvement, is it? That's a whole different ballgame for data centers worried about power costs. So naturally, this news just sent the stock flying, up over 155% in one day. Crazy. But here's the conflict, the big question you need to wrestle with this company. It's not profitable right now. Negative cash flow, negative EPS. So why are traders suddenly paying such a premium? Why bet big on the future when the present looks, well, murky?
Yeah, that's the classic tension you see with these high-growth tech stocks, that low-energy news. It gives the stock a massive fundamental reason to re-rate higher. But you're absolutely right about the financials. They reflect, long sales cycles, reliance on older, lower-margin stuff while this APU thing ramps up. So now all eyes are glued to their earnings call. That's October 30th. It's the first real chance to hear from them directly. How does this amazing validation translate into actual sales? What's the guidance look like? That's what everyone wants to know.
Okay, so given that conflict, amazing tech versus shaky current numbers, how are people actually trading this? What's the sentiment? Seems split. Like, short interest is tiny, 1.09%. Almost no one is betting against it, despite those financial risks. Why?
Well, simply put, that Cornell validation. It's external. It's credible. Hard to argue with. When a third party confirms a near 98% energy advantage, well, short sellers get nervous, really nervous about unlimited upside. They tend to run. But look at the options market. It's telling a more cautious story, sort of like buying insurance. The put-to-call ratio is 1.14. So slightly more bearish bets, or maybe just hedging existing positions. And you can see clear levels there. That $7.50 mark, which was the old resistance, that's now acting like a floor in the options world. And $5 is like deep insurance below that.
And the chart itself, just pure conviction, right? The technical breakout was just historic. It blasted off from $7.50, closed near $13, even spiked above $18 during the day. And the volume, it was an absolute flood of money. Astronomical, confirms everyone, big institutions, retail traders, they were all piling in. The trend is just aggressively bullish.
It is, but that speed, that raises a flag for the next few sessions. That move was incredibly fast. Our key momentum indicator, it's now deep, deep into overbought territory. That's a serious warning sign. It suggests the big money, the institutions, they might just wait for a pullback, some consolidation before putting more money to work. It could force a cool down, at least temporarily. And volatility, it went from 0 to 60, or maybe 0 to Mach 1. Expect really big price swings both ways, a real sonic boom.
Okay, so let's pull it all together. Synthesizing our research, our outlook here is cautiously bullish. The immediate risks are pretty clear, right? That overbought signal you mentioned, the weak broader market could drag anything down, plus that hedging we see in the options.
Definitely risks. But the core reason for being bullish, even cautiously, is just so solid. You've got that external Cornell validation, a fundamental game changer, and it was backed up by that powerful technical move on huge volume. You can't ignore that.
So the key levels for you to watch right now. First defense is that $12 and $15 zone 2. That was yesterday's close. If it holds there, the path to retest that $18.15 high stays open.
Yeah, and the whole bull case really only gets into trouble if we see a decisive break back below the launch pad, back below $7.50.
So GSI Technology, kind of proving that sometimes using way less power can generate some seriously explosive returns.
Absolutely. But maybe a final thought here. After a 200% jump in a day or two, caution is probably the smartest kind of energy conservation for your portfolio right now. That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.